Hello, hi guys. This is CA Balakrishna from Lecturepedia.in. How are you? Hope you people are doing well. Even I am fantastic. In the today's class, we'll be revising SRE 2400. That is standard on review engagements. Basically, here in this review engagement series, we will be having two standards. One is SRE 2400 and SRE 2410. will be I'll be explaining you what is the difference between SRE 2400 and 410, when you should apply 400, that is SRE 2400, and when you should apply SRE 2014. First of all, we'll understand what is meant by a review, what is difference between audit and a review, and who will conduct audit, who will conduct review. See, in case of audit, you will provide reasonable assurance, right? Whereas in case of review, you will provide only limited assurance. Now the question that arises is, what is the difference between reasonable assurance and limited assurance? Basically, in case of reasonable assurance, the type of opinion that you give, it will be positively worded, whereas in case of limited assurance, the type of conclusion that you give, it will be negatively worded. How? See, in case of audit, audit of financial statements, what will be the wording of your opinion? It will be financial statements as a whole or free from material misstatements, whether due to fraud or error. Like this, you will write in your opinion. Okay, in your opinion, financial statements are free from material misstatements. Like this, you will write, which is positive. Okay, you are confirming that financial statements are free from material misstatement. In case of limited assurance, that is in case of review, the type of wording will be based on our procedures. We have not come across any areas which makes us to believe that financial statements are uh, which makes us believe that there are material misstatements in the financial statements. That means here in case of review, you are saying that based on our procedures, we have not come across any misstatements, but there can be misstatements in the financial statements. See, in case of assurance, that is reasonable assurance, you are confirming that financial statements are free from material misstatement. But in case of review, you are saying that you have not come across any material misstatements during your audit or review procedures, but there can be misstatements in the financial statements. That is, here in case of review, the conclusion is negatively worded. That is the difference between reasonable assurance and limited assurance. Okay, so I have given what is difference between audit and a review. Now, in order to deal with this review, first of all, audit has to be mandatorily conducted by chartered accountant only, right? Now, whether review should also be conducted mandatorily by a chartered accountant? Yes, only a chartered accountant can conduct review of financial statements. Other than a chartered accountant, no other person can conduct review of financial statements. Hope that is clear. Now, in order to provide certain guidance, certain procedures with respect to the review that will be conducted by a chartered accountant, the institute, it has issued standards on review engagement, basically 2400 and 2410. So SRE 2400, SRE 2410. What will be dealt by SRE 2400? If you see the name of the standard, SRE 2400, engagement to review historical financial statements. Okay, review of historical financial statements. Just a second. Okay, I guess this pen, okay, it's working. So if you see SRE 2400, it deals with engagement to review historical financial statements. If you see SRE 2004-10, the name is Review of Interim Financial Statements performed by independent auditor of the entity. So the main difference between SRE 2400 and SRE 2410 is, if review is conducted by a chartered accountant other than auditor of entity, in that case you need to apply SRE 2400. In the same way, if review is conducted by a chartered accountant who is also auditor of the entity, in that case you need to apply SRE 2410. This is the main difference between 2400 and 2410. Now, what are the examples of situations where SRE 2400 will be applicable? Let's say there is a company. That company, it wanted to take a loan from a bank. Now, as per the loan agreement of the bank, in order to get the loan, the financial statements of the entity has to be reviewed by a chartered accountant other than auditor of the company. Okay, the bank wanted the financials of the company to be reviewed, not audited, by a chartered accountant who is not auditor of the company. Auditor of the company, he will however conduct audit of financial statements, but we will not completely believe on auditor. Either we will appoint another chartered accountant, or you yourself appoint another chartered accountant and conduct a review of the financial statements. Another time again audit is not necessary, you just conduct a review of your financial statements and submit that review report. Okay, this is one of the scenario where review of the financial statements may be conducted. Another scenario, let's say there is a partnership firm, and for this partnership firm, however, audit as per Companies Act, it will not be applicable for partnership firm. uh, Tax audit can be applicable, but for this partnership firm, tax audit is also not applicable. Its turnover is within the limits. Now, even though tax audit is not applicable to the partnership firm, the partners of the firm, they voluntarily wanted to conduct a review of financials of the firm by a chartered accountant. Okay, in this type of engagement also, the chartered accountant who is accepting that engagement must comply with SRE 2400. Hope that is clear. Now, coming to the examples of where SRE 2410 will be applicable. However, we will be discussing that while discussing that SRE 2014, but I'll just give one example of where that 2014 will be applicable. In case of listed companies, they need to conduct limited review, and they need to submit that limited review report to stock exchanges as per LODR regulations. Now, that limited review, it will be conducted by statutory auditor of the company himself. So here, since the statutory auditor himself is conducting the review of quarterly financial statements, for that type of engagement, SRE 2004-10 will be applicable. Hope that is clear. So these are the situations where you will be applying 2400 and 2014. Here are also the examples that I have given. Now, while conducting this review engagement, practitioner, basically in case of audit we will be calling him as auditor, right? But in case of review we will be calling him as practitioner. Now, the practitioner, while conducting the review, he must comply with all the relevant ethical requirements like integrity, objectivity, confidentiality. All that ethical requirements he need to comply, including independence. Hope that is clear. And practitioner himself is responsible for ensuring appointment of quality reviewer for that particular review engagement. Hope that is clear. Now, in order to accept the review engagement, there are certain preconditions. These are normal, general. Okay, the general preconditions that we have been discussing from almost in all the standards. Okay, in standards on auditing we have discussed this. In also in 3400 series, there also we have, not 3400, 800 series, there also we have discussed these preconditions for accepting the engagement. Now, in order to accept the engagement, first of all, the applicable financial reporting framework that is being used for preparation of the financial statements, that must be acceptable. Yes, and also the management should agree for its responsibilities of preparation of financial statements as per applicable financial reporting framework, and also to establish internal controls in the organization. Management, they should agree that this is their responsibility. Only then the practitioner, he will accept the engagement. And also management should agree that they will provide the practitioner with all the information that is relevant in the context of preparation of financial statements. And also the management will provide the additional information that has been asked by the practitioner, and management will give unlimited access to all the persons within the entity for the purpose of practitioner to conduct inquiries. Okay, all this must be, access to all this must be provided to the practitioner by the management. Okay, all information that management is aware of, and additional information required by the practitioner, and also unrestricted access to the persons within the organization, all that information must be given access to the auditor. Next, if the practitioner is not satisfied with any of the above, okay, if the management is not providing any of the above information, or practitioner is not satisfied with the applicable financial reporting framework, then what the practitioner should do? See, if the practitioner is not satisfied with above before accepting the engagement, then in that case you discuss with the management, you discuss with those charged with governance, and ask them whether they will change it. If they don't alter, then you should not accept the engagement. Hope that is clear. In case after accepting the engagement, the practitioner became aware that he is not satisfied with the preconditions, okay, the preconditions for accepting the engagement are not present, in that case what he should do? Here also he should discuss the matters with the management and check whether those matters they can be resolved, and what will be the appropriate action that he can take. Okay, whether he can continue the engagement or he has to withdraw from the engagement. If he cannot withdraw from the engagement, how he has to report this matter in his report, in his review report, that he needs to consider. If after accepting the engagement uh, he comes to know that preconditions are not present. Hope that is clear. Next, overview of performing review engagement as per SRE 2400. There are certain steps for conducting the review engagement. First of all, just in case of audit, if you have been appointed as an auditor, what you will do first? You will understand the entity and its environment in order to identify the risks, right? Here also in case of review, you will first of all understand the entity, and you will also determine the materiality in the second step. By this first step of understanding the entity, you will come to know about the risks that are present in the entity, and in the second step you will determine materiality. Now for this materiality, the professional judgment of the auditor, professional judgment of the practitioner is required. In case of audit also you will determine materiality, so the professional judgment that is required for determining materiality as per audit and materiality as per review, both is same. Okay, the materiality will be same whether it is audit or it is review. Hope that is clear. After that, you will design and perform the procedures, review procedures. Now basically 99% of the procedures that the practitioner performs in case of review is inquiry and analytical procedures. Okay, these two are the major procedures that the practitioner will perform in case of review. However, in certain necessary cases he will also perform certain other procedures, but not to the extent that he performs in case of audit. Since in case of audit he needs to give reasonable assurance, he will extensively perform all the procedures, but here in case of review he will give only limited assurance. So the procedures, the review procedures that he performs will also be mostly limited to this inquiry and analytical procedures. Next, the practitioner he will also perform certain additional procedures in case of certain specific circumstances. Now in the standard there are certain 4 specific circumstances that have been described. Of those, the first circumstance is related parties. With respect to related parties, during the entire review the practitioner has to be alert to find any conditions that will inform the auditor about existence of any related party relationships or related party transactions that were not earlier communicated to the practitioner. Okay, that procedure he need to apply in case of related parties. And with respect to the non-compliance with laws or regulation, if the practitioner comes across non-compliance with laws or regulation during his review, he has to first of all communicate it with management or those charged with governance. And also he should determine whether there is any responsibility on him to communicate this matter to any third party outside the entity. Generally, in case of audit, as per Companies Act, if there is this non-compliance, sorry, as per SA 250, if there is non-compliance of law or regulation, you will be reporting it in the audit report, right? In the same way here also, you need to determine whether there is any requirement to communicate this non-compliance with any third party. Hope that is clear. And next, going concern. If there are any events or conditions that may cast significant doubt on entity's ability to continue as a going concern, then the practitioner, he has to determine what are the future actions of the management in order to mitigate these conditions, and what is the feasibility of those future actions, whether those future actions will mitigate the conditions or not. This must be determined by the practitioner with respect to going concern assumption, if there are any events or conditions that will cast significant doubt on entity's ability to continue as a going concern. Next, whenever a practitioner, if he wanted to use the work that is performed by other person, whether he might be expert or other practitioner or other auditor, then he needs to determine whether the work that has been performed by such other person is adequate for the purposes of the practitioner. Based on that, he needs to determine whether he can use his work or not. These are certain procedures that you need to perform in case of those specific circumstances. Next, whenever necessary, apart from that inquiry and analytical procedures, you can also perform other audit procedures if necessary. Hope that is clear. Next, written representations. The practitioner, he should also obtain written representation from the management. Basically, these are the normal written representations. Firstly, with respect to the responsibility of the management regarding preparation of the financial statements as per applicable financial reporting framework, whether management has fulfilled its responsibility or not. This representation you need to ask from the management. And also whether all the transactions that have taken place have been properly recorded and reflected in the financials. Even this representation you need to ask from the management. And also you should ask from the management whether management has disclosed to the practitioner all the related party transactions and all the related party relationships that are known to the management. With respect to related parties, this representation the practitioner should get from the management. And also whether management has disclosed all the known non-compliances with laws and regulations. Even this written representation the management should give to the practitioner. And also the information related to the frauds that has taken place during the year, even that you need to give. And with respect to the going concern assumption, how the management has assessed its ability to continue as a going concern. Okay, even this representation the management has to give to the practitioner. And management, whether it has properly adjusted all the adjusting subsequent events as per the relevant standard or not. Okay, even with respect to this, the management has to give written representation to the practitioner. Now what if those written representations which the practitioner has requested are not given by the management, then in that case discuss with the management or those charged with governance why you are hesitating to give these written representations to me. Okay, and you consider the reasons that are given by the management or those charged with governance, and determine whether there is any impact on the integrity of the management. Because of that, whether he can rely on the written representations that are previously provided by the same management. Okay, if management is lacking integrity, then there might be chance that the previous written representations that have been given by the management, even they might not be reliable. So now whether I can rely on those written representations or not, even this you need to, even from this angle you need to think. And in case management you feel that there is a sufficient evidence in order to doubt about the integrity of the management, and because of that the written representations that are provided by the management are not reliable, okay, if you have sufficient evidence to believe this, then you can either disclaim your opinion or disclaim your conclusion in the review report, or you can withdraw from the agreement from the engagement if possible. And also if management is refusing to give basic minimum written representations with respect to its responsibility for the financial statements, in that case also you can determine whether to give disclaimer of opinion or to withdraw from the engagement. Now coming to the type of conclusions, basically the type of conclusions, it is similar to that of type of opinions. Okay, unmodified conclusion. In case of modified conclusion, there will be qualified conclusion, adverse conclusion, and disclaimer of conclusion. Now what would be the wording of each type of conclusion, that we'll see. First of all, in case of unmodified conclusion, if you are following fair presentation financial reporting framework, then the wording of the conclusion paragraph will be like, nothing has come to our attention that causes us to believe that financial statements do not give true and fair view. Okay, that is negatively worded. During our procedures, nothing has come to our attention which causes us to believe that financial statements are not showing true and fair view. That means financial statements are showing true and fair view. Okay, based on that is, you are just saying that we haven't found any misstatements, but there might be misstatements. Hope you are able to understand. Next, compliance financial reporting framework. Here also, based on our review procedures, nothing has come to our attention which causes us to believe that the financial statements have not been prepared as per the financial reporting framework. The only difference is, in case of fair presentation framework, you will use the terminology true and fair view, whereas in case of compliance framework, you will not use that true and fair view, but instead you will say that the financial statements are either prepared or not prepared as per the applicable financial reporting framework. Next, in case of qualified conclusion and you are using fair presentation framework, in that case, except for the matters that are described in basis for qualified conclusion paragraph, nothing has come to our attention that causes us to believe that financial statements have not been prepared as per the financial statements are not showing true and fair view. Okay, nothing has come to our attention which causes us to believe that financial statements are not showing true and fair view. If in case the compliance framework is used, except for the matters that are described in basis for qualified conclusion paragraph, nothing has come to our attention which causes us to believe that financial statements have not been prepared as per the financial reporting framework, the applicable financial reporting framework. Next, adverse conclusion. In that case, you will say that due to significance of matter that is that is specified or described in basis for adverse conclusion paragraph, financial statements are not showing true and fair view. Here you have concluded, you are straight away saying that financial statements are not showing true and fair view because it is adverse conclusion. Okay, how you will determine these types of conclusions? Again, same rules that we have discussed in SS 700 705, the same rules you will apply based on materiality, pervasiveness, and the audit evidence. Based on that rules only, you will determine whether to give unmodified or qualified, adverse, or a disclaimer of conclusion. And if you are giving disclaimer of conclusion, then due to significance of matter that is described in the disclaimer for a conclusion, basis for disclaimer of conclusion paragraph, practitioner is unable to obtain sufficient appropriate audit evidence from the review procedures that he has performed. This will be the terminology that he will be using. And coming to the practitioner's report, even this is also general format. First of all, you will be having title and addressee, then there will be an introductory paragraph. In this introductory paragraph, you need to identify the financial statements that you have reviewed, and you should also identify the title of each of the financial statements, and you should make a reference to the summary of significant accounting policies that have been used for preparation of these financial statements, and also you need to state that financial statements have been reviewed. Okay, you need to state the fact that you have reviewed the financial statements. Next, there will be management responsibilities. What are the responsibility of management that you will specify in that paragraph, and you will also specify the responsibilities of the practitioner. And if the financial statements are prepared as per special purpose financial reporting framework, then in that paragraph you need to specify what is the purpose of these financial statements and who will be the intended users of these financial statements. And if management is having a choice for selection of the applicable financial reporting framework, then you need to specify that it is the responsibility of the management for selection of those applicable financial reporting framework. And you should also give description of review of financial statements and its limitations. And finally, there will be a conclusion paragraph, basis for conclusion paragraph, and date, signature, and place of the signature. And again, the requirements with respect to emphasis of matter paragraph, other matter paragraph, and other regulatory requirements, all that will be as it is applicable as in case of audit. Okay, emphasis of matter paragraph you will give when the auditor wanted to emphasize a particular item that is present in the financial statements, if it is very much important for the users understanding of the financial statements. And other matter paragraph, auditor, he will provide those matters which he thinks are necessary for the users to understand about the audit in case of audit, here about review and other reporting responsibilities. Finally, you should also maintain documentation with respect to this review engagement that you have conducted. Okay, this is a brief revision of SRE 2400. This chart you can get it from the link that I will be giving you in the description. Okay, and if you want to purchase our classes, you can visit our website lecturepedia.in and you can place your order. Hope that is clear. Now I'll be winding up this class. As of now, we'll be meeting in the next class with SRE 2004-10. Okay, take care, bye bye, see you.